Well, I'm doing this as therapy. So I'm looking forward to like talking this out. I have to talk out my Wyckoff conundrum with everyone here so that I can see if I can, with your help, figure out my problem, which is being at the fork in the road. And so, brilliant guy, 13 World Series, just maybe the best catcher to ever play the game, just a wonderful human being. And I call him a Wyckoff expert. I doubt that he ever knew uh, who Wyckoff was, but for his wonderful witticisms, he's got to be a Wycoffian of some kind. So anyway, so here we go. First of all, I want to make an announcement. The TSAA SF is this wonderful society, not-for-profit, oriented towards technical analysis, education, and it's just a great organization and very devoted people that are running it. And we just announced yesterday our speaker for March, and he's a Wycoffian and just a wonderful person, a wonderful educator, a friend. And I'm thrilled that he's going to be on the speaker docket for March. And this is Gary Follett. So you can go to the website. This is a member event, but membership's only $75. And there's something going on constantly through the year. And our officers are always working to do more to make the organization relevant to its members. So check it out. Okay. And so take the fork in the road. This is actually a blog that I wrote back in 2015. And it was about really about distribution. But I really have, and please go back and look at these. You can go into the archives and see the different blogs that we're doing. But what I have here is I have two events that I want to discuss relative to the current market, and see if I can, through this Wyckoff therapy that we're going to do today, see if I can organize my thinking about what to do given the place that we're at. So this is a distribution schematic. We'll come back to that as time goes on, but you're going to see a family resemblance in this to the current market. And here is a reaccumulation trading range, which I actually did a power charting episode that you can see about a week ago. So go back and look at that in the StockCharts TV channel. And I talk about reaccumulation structures and look at case studies. So we're in one of, I believe we're in one of these two conditions. And I would like to have a discussion about how we can tell which one we're in. And the whole idea about taking the fork in the road, Wycoffians are tape readers. So I want to say that I have a bullish bias. My orientation is towards rising prices because that's the long-term trend of the market for decades. Yes, there are some bear markets that come along. So, but my bias is bullish, but I'm a tape reader and I let the market tell me where it wants to go. That's the Wycoffian way. So let's see if we can get the pulse of the market from a Wycoffian perspective here. And I want to go back and do a little review. You'll see at the bottom of these charts the where this chart came from in my blog post archives, and you can go back and look at these, pull them out, blow them up, and so on. But here, this Dr. Pruden was my teaching partner, my mentor for 35 years, almost 40 years. And Dr. Pruden was an amazing Wycoffian, an amazing point and figure analyst, and he did a point and figure study of the stock market back in 2003 and made an amazing call using point and figure analysis that got within 200 points on the Dow of the final high from the lows back in the prior bull market of the early 2000s. And then he did it again here in 2009. And this green line here represents the area on the vertical chart I will show you the point figure chart in a minute, but the green area represents the count that he took initially off the 2009 lows and made an amazing call, because the Dow was, at the point he made this, did the study, the Dow was still under 8,000. And he said, based on point figure analysis, that the Dow Industrials in this case could get up to 17,600 to 19,200. So I replicated his count for the blog that I did, Point and Figure Pie in the Sky, and look what happened. We had this glorious uptrend, and this is when people were just very bearish on the market. As a matter of fact, it's the most bearish period I've ever seen in my career. And look at where the market went to. It got right up to the between 17.6 and 19.2 and hit the wall. And so it got above the trend channel, spent some time up there, couldn't really pull away from it, stopped there, and paused for 18 months. And this 18-month pause was a significant period of volatility for the stock market in 2015 and 2016. At that time, I wrote, at the conclusion of all this, at the point of this last bar here, I wrote this Point and Figure Pie in the Sky, and with Hank Pruden and Roman Bogomazov and myself, we did this analysis and said, can we make this count bigger, which is a normal procedure in point figure analysis. So this count worked, the green one. We stretched it out and said there's a bigger count here that we can take, and this count went 22,010 to 23,000, call it 700. And then we had what we call a reaccumulation count, which went in this 2015-2016 area, that went 22,850 to 24,483. And at the time, the Dow was at 18,568. And people thought that I was getting way ahead of myself, that I might be actually trying to participate in the cannabis movement too early. But in fact, I made this analysis and wrote this blog. I was very sober, and I was thinking people are just going to think I'm nuts. And so this count, 18,600 to 22,850, 24,483, this count pretty much confirmed, this big base count pretty much confirmed this reaccumulation count. And so we can see here that this is the area of the reaccumulation count in green. And so what happened? Well, first of all, let's look. I will let you go back and study this chart, but I do want to say one thing about it. This is the chart that I assembled back in 2016 for that blog, which replicated Hank's count in green here and then the larger count in red. But I had two more columns that I could legitimately count here, and I put those on today, and that took the count up to 22,900 to 26,358. And so this is the larger count. And let's move on. And here's what happened. And so you can see that this count here was largely fulfilled. It got right into this area. This count, it went right into the area of this climactic surge. And notice how this was a huge buying climax that went up to January 2018, and then had a large reaction. This set up a range-bound condition. We'll look at this a little closer in a minute. And I said at the time that I wrote this blog that the Dow was becoming climactic. This data here is since then. And we can see that these counts did a really good job of targeting the range where the market went to, and the market just hit the wall. So we also keep in mind this larger count that went to like 26.6. Well, I believe that the high was just at 26,900. And so it got very, very close to the final high if we stretch that count a little more, which we didn't need to do because it still worked really well. Okay, so this is the count of the 2015-2016 area, and you can see that this is in More Pie, Bigger Sky that was published in 2017. And right when it broke out, we said, okay, this is how far this could go, 22,850, 24,483. And so do go back and have a look at that. Now, I want to shift gears here, and I should keep track of the time because I want to make sure I don't go over, but we're in good shape for time. So this is the big question currently off the December 24th low, was where will the current rally pause? You may have seen me do some work on this in a blog I just published, and also I did it in Power Charting. I looked at these. This is brought up to date through today. You'll see here that Wyckoff draws trend lines differently than most other technical methods. And the Wyckoff method is really oriented towards using trend lines and channels for trading purposes. So you can see here that what we try to do is we try to draw off the two important points that come up very early in an uptrend. So these square boxes here represent the two adjacent points that we draw it from. I have a full description in this recent blog that I did on trendline drawing, so please have a look at that. And then on the intervening low, or otherwise the high, if you draw it the other way, and I'll show you that in a minute, you draw a parallel. So you're drawing the parallel of this line, the solid line, off this intervening low, and that 1 point. So there's only 3 points in trendline drawing in Wyckoff. And you can see here how beautifully this came up to the top of the channel, threw over a little bit, and then came right back down to the bottom. And then you can see here from this trendline analysis that the rate of advance is slowing. And let's zoom in. So you can see here we drew a new trend channel here off this point and the intervening low, and we can see that the rate of advance is slowed. Well, look at how well both of these trend channels were respected. So here we can see that it rode along the bottom of the green oversold line, we call this, for a period of time, and then it dipped below it, stayed below it. The slower trend channel came into effect, continued to be in effect, and it was riding along the top of that. Rallied up to, on a gap, up to these two trend lines together, and that was it. And since then, it's been cascading down. It's gotten to the slower trend lines, oversold line, and now has fallen through it as of this reading that we took today. And so this is the condition that we have. Let's move on. One thing that I'd like to point out is this downtrend line. This is a classic downtrend line of this December decline. 2 points, intervening low, trend channel. Look what happened. This is classic when you get into a selling climax area or a buying climax area. Look at the failure of the channel, oversold, and a throw under of the trend channel. This is a classic place where exhaustion occurs. It happened beautifully on this 2-hour chart. And then look at the change of character in this rally. It just turned up and went right up and out of the downtrend channel and off to the races it was. Okay, so now we're going to go to a weekly chart, and we're going to use completely different time frame to draw our trend channel. And so here you can see this is what we call a demand line. This is the normal use of trend lines, which is draw the demand line first, unlike the last example, but we draw them however we can do it. So we just find trend lines and draw them. We can usually see what the primary trend lines are very easily. 2 adjacent lows, intervening high, demand line over bought line. Well, look what happened. This is the beginning of 2016. So this is a weekly chart. And you have this dramatic run up and throw over of the channel. And this is January of 2018. We wrote blogs about this. Look at the failure off this buying climax. Very clearly, this was a buying climax and a failure. Well, the failure was a very sharp decline and only took 2 weeks. Look at the volatility here and the huge volume. Well, it went right back down to the demand line, bottom of the channel. And then it rallied again, rallied up to the top of the channel for a secondary test. And in Wyckoff, we're always looking for these three places. And this is important here, is we look for 3 places to show, 3 events that show that a trending market is becoming a range-bound market. Buying climax, automatic reaction, secondary test. So we have these 3 events here. Now we go from trending to a trading range. And then in the evolution of the trading range, we attempt to determine whether we're seeing distributional characteristics as the trading range matures, or we're seeing reaccumulation for another move up, which we saw in that 2015-2016 example. Okay, well here we can see, and this is something I really want to focus on. Buying climax, automatic reaction, secondary test. We pointed this out at the time that it happened. And we draw a resistance line at the buying climax and the secondary test. We have a throw over of the upthrust into an upthrust here, and then a massive failure that is a major sign of weakness down and out of the range, which produces an important rally back up into the trading range and upward. Now, what I want to point out is a couple things. The demand line held here. It held all the way through here, which was a number of attempts to go below it. It held beautifully. These were buying opportunities. That's why we do trend channels. This was a selling opportunity throwing over the top. And so here we can see a rally up. It can't get back to the top of the channel. It goes above the resistance area briefly, 6 weeks, and then fails. And it has a massive failure, but it fails not only below the resistance line, fails below this resistance line, and it fails below the channel. It's out of the channel as of the last part of the year, October, November, and December. Well, look what happened at this resistance, 2,800 on the S&P. It touched here, had a sharp break after it rallied to this area from underneath. Rallied here, touched, had a sharp break, rallied here, touched, had a sharp break, rallied here, had a much bigger break. And so 2,800 is a place where sellers are supplying the market with stock, and look what happened. Look where we are. All of a sudden, so we're asking the question, where would this rally stop? And so we pointed out that this was an important resistance area and a classic place for the market to go back down again, and that appears to be what's happening. Okay, so now the last thing I want to make here is that looking down at this area is we could very well be here at this upthrust, and this weakness that we've just had down through the support area and a rally up could be setting up a condition for a run up to another high. Even under distribution, we could have another high here, and I think this is an important scenario to consider. And so maybe we get a pullback, and I'm going to talk about how this pullback could develop in a minute.
Hey, Bruce.
Yeah.
Okay, so if you look at that 2016 to 2000 or late 2016 to 2019 advance, you had I think on the other slide you had that trend line drawn. Yeah, right there. Now on that advance, I mean the S&P 500 gained probably about 65% in 2.5 years, which we both know, and I think everybody listening knows, is an unsustainable channel. I mean, you know that channel is going to break at some point because the stock market doesn't go up at that kind of a rate for very long. It's just not possible. So how much of this, when you see a trend like this, are you anticipating that break, or do you just say, we're just going to ride it until it breaks?
Great question. What I would look for in the Wyckoff structure is a buying climax, is ideally as a buying climax with a throwover of an important trend channel. And so this is exhaustion. Usually when you get a move of this magnitude, it's going to have a climactic exhaustion move at the conclusion. And this is exactly what we saw here. And it was dramatic. It was a huge move in December, January of 2017, 2018. And then, but the more important probably answer to this would be that after you get the buying climax is that you have a sharp break that is greater in magnitude and volume than anything that preceded it in the uptrend. So if you look at any of the reactions, all the reactions in the uptrend are pretty reasonably modest until you get to here. And this decline is of a magnitude different than anything that preceded it going back to late 2015, 2016, which started the uptrend. And so this is what tells us the combination of three things: the buying climax, the automatic reaction, and the secondary test tells us that for the time being going forward, we're in a range-bound condition. And then we assess the range-bound condition for whether or not it's reaccumulation or distribution, and you can trade that. We actually did point figure analysis of these areas in here and got great counts. I actually have some examples here, but I doubt I can get to them today. But this count took us right up to the upthrust peak. And so this was very tradable. But the rally in and of itself was, you know, a standard rally, nowhere near as dynamic as the rally that preceded it. And so there was an element of weakness in this advance that suggested that there was some selling going on, some large sellers using these rising prices to sell stock. And then, of course, it was confirmed by the sharp decline that came after. So, but these 3 points, buying climax, automatic reaction, secondary test, would be the evidence that would tell us this is where we are, that we've changed the nature of the trading in the market for the time being.
Okay. We did have a couple questions, and I know, you know, we're going to probably have trouble, you know, with time, but maybe these are things that we can think about for future appearances when you come back. One, well, the first one is on Renko charting. Can you compare and contrast Renko charting with P&F charting? And then the other is, and this is one we probably will cover on Market Watchers Live from time to time, or, you know, we can cover. But the second one is the dollar is breaking out the new highs today. Why is the bond market doing so well at the same time? With normally the yields go up and that strengthens the dollar. But I could just briefly say that, you know, on the second question, that it really has to do with our bond market versus foreign bond markets. And I haven't looked at, for instance, Germany, but I do know that the dollar has been going up over the past 10 years, mostly because our yields have been going up faster than Germany's yields, you know, the yields over in Europe. And so that tells me that our economy is stronger, and as a result, we get the stronger dollar. Now, I haven't looked today to see, but I have a feeling based on what the ECB came out and said about, you know, that the lackluster economy in Europe and seeing what's going on with the euro, I can only imagine that even though our yields are dropping, money going into treasuries, I think that probably the yields are dropping even faster in Germany. But again, I haven't looked at that yet today, so might be speaking out of turn. But that to me would be the reason why. But do you have any comments on the Renko charting?
Renko is not something that I do, but I do know a number of Wyckofians that use them and like them. I find that point and figure charting, classic point and figure, does such a good job. I'm so comfortable with them for doing price objectives that I really just spend all my time, more time on point and figure than on vertical charts like these. But that's just my preference. But I do know a number of Wyckofians that really love them.
Yeah, and I'll just add that I know Renko charts really don't pay any attention to time, that it's really just about the price changes that meet certain requirements.
And that's a point and figure phenomenon too, in the way they're constructed.
Yep, yep. And I think Renko uses bricks, whereas point and figure kind of has the boxes or whatever going higher.
Well,
yeah. So anyway, just wanted to point that out. So, but maybe that's something that maybe for a future show we could use as a topic, because I know that question comes up from time to time.
By the way, there's a point and figure workshop that I did last summer, I think it was, and Zach and the crew put that two-part point and figure series up often, and look for that and play it to get sort of an overview of how point and figure works for horizontal counting method. And so look for that in StockCharts TV. So finally, I just want to show this monthly chart, because here's again another different view. I find this chart amazing, actually, and that is look at these 2 points here. This is the low in 2009. Here's the next important reaction. Big, very long demand line, 10 years in the making. And this got very close to touching it, a great place to find support and rally. Look at the rally that came thereafter. This is the area that we're in now. We'll look at, if we draw this trend channel here, look at where we are on the monthly. This is a monthly bar, the last bar. It's right there. This should be important resistance right here. So these three trend charts all have elements of resistance that the S&P is right at this 2,800 level. And in fact, we are starting to see weakness. You can go back and look at this chart in this recent blog. Now what I want to do is finally, I'm just going to breeze through this. This is not in a blog. I actually did this chart for today. But this is the base 30-minute chart, 3-box reversal. I used average true range scaling. These are great tools in StockCharts point and figure charting engine, and counted this 23 columns, and these 23 columns gave us a count 26,075, 27,012, and you can see that. Look at what happened. We draw a trend channel on the point figure. Look what it did at the end. It threw over, became overbought. That's classic overbought. Now it's pulled back in. I don't have the most recent data, but I believe that we're out of the bottom of the channel. Big change of character in the way this is trading all of a sudden. And this is just using 30-minute data, and captures the whole move up. And we fulfilled the count. We went into the area of the count range, and a change of character. So this is like I call it a trifecta. Point figure count fulfilled, went up to resistance. It's at the resistance I showed on the prior 3 charts, and then there's a trend line throw over, and this is a classic overbought condition. Great place to probe the market or to sell some stock. Okay, and then what I want to do, and I'm going to do this really fast because I want to get it in. I'll pull these up. There's 3 important rallies back in 2015, 2016, and we studied this in the blogs. You can go back and look at these. But these rallies may be akin to the rallies that we've seen, the rally we've seen here in the beginning of 2019. Very sharp, persistent runs upward. Well, there were 3 pauses, and I want to just offer this as a scenario for what could happen. In this case, there was a pause. These produced really good point figure counts. This base, this area in the orange, and then downward to another base. These were great counts, and this you can see. Look at the volatility. volatility is very high throughout this whole period, and then it just collapses back down again. This looks like there's distribution going on because of the sheer volatility. We're looking for absorption of stock in the pauses. And this next area here, look at the difference. It goes sideways throughout, does not break down, and stays in the top third of the prior run up. This is what I will be looking for after the recent run up into the recent highs that we've just had, is that we have, look at how the volatility is much diminished. It takes more time, more bars, and they're smaller bars to go down. Really good bullish bar up, 3 bars down. It sprung the low, but the big clue was, because this is a spring, is if it springs the low, and then look at this bar, it comes, produces a tail, has a big run up, closes very near the highs. And so this is a very big clue that this is a reaccumulation, that a backing up action, we would call it, that is going to go higher. And then it did it again. Again, this has much less volatility in it than this area in the orange. And you can see, sprung the low at the end, turned around and had a big bullish bar, closed very close to the high of the range, and it was up and out. And so these big reversal up bars after a spring are the clue that you should get busy, and that this is there's a bullish tone to this market. I'm going to suggest that this is what to look for from here forward, is to confirm that this rally that we've just had is a rally of where stock is in very strong hands, and there's an attempt to pull back, which we're in now. Probably be the most volatile part of this decline will be the part that we're in early, and then it starts to become dull and quiet, stays towards the top of the range of this recent rally, 19% move up, stays in the top third, and then does something akin to the blue box and the yellow box, and attempts to then run to the highs. This is what I'll be looking for as a bullish bias. The thing that I would be worried about would be if we break down from here and go right back down to the support of the automatic reaction in February of 2018. If there's weakness, big wide-ranging bars, ease of movement down, very high volume, this I think will say that we're in a distributional type structure. And I'm going to let the market tell me. My preference is to see something akin to these last two pauses. This whole area here from the blue over to the middle of 2015 was a beautiful point figure count. It's the count I showed you earlier that went up to 24,000. Okay, we are about out of time. And so I want to show you, if I can, this chart. By the way, tomorrow I'm doing a power charting on contrary opinion. This is the most brilliant chart schematic that Hank Pruden authored, created, and it took me months as a young technical analysis student to get the hang of this chart. But it's so good on all the elements of price, momentum, sentiment, volume, and contrary opinion, and how they all fit together. We're going to have a big discussion about that tomorrow in the new power charting episode that's coming up at 3 p.m. Eastern. Okay, last thing I'm going to show you, I'm going to do this really fast, is this is a sentiment index which is going to be discussed tomorrow. Excuse me. And this Joe Turner in early January presented this chart, and the reading here was like 3 or 4. There's 7 sentiment components in this index, and this is about as low as you can get. The most fear that you can get in a market was at the January lows. Well, look at how fast the fear became greed, and using CNN's terminology. And the reading went from about 3 or 4 to 72. Currently, I think it's 63 as of today. 19% move. Look at what happens when you get these extreme fear readings below 20%, is you can have really large swing moves. And you see here that this index gives you 2 to 3 good junctures per year of extremes of extreme pessimism or extreme optimism. So you can go check this out on your own, but it just reached 72, which is a very high reading. It happened very fast at the beginning of the year and produced a 19% gain. Well, we've used up a lot of the fear, and now it's become, it's flipped. And lastly, and I thank Pring Turner for allowing me to use these. Joe Turner is a brilliant model builder. This is one of the models that Pring Turner has constructed. This is the fuel tank. The fuel tank was 96% full at the beginning of the year. So a lot of fuel for an important move. And we saw that was about a 19% move. Well, now you can see when it gets under 20%, the fuel tank is pretty close to empty. And so you can see here the empty, what happens when the tank's full and when the tank's empty. And here you can see this all occurred in an uptrend, good upside bias. This is the New York Composite. Notice the downtrend in the New York Composite, lower highs, lower lows, and we have now used up most of the fuel in the tank. So I believe that an overbought condition should be treated very carefully. And lastly, Pring Turner does publish a lot of their research, and this is our Martin Pring at StockCharts.com, and one of my mentors and one of my dearest friends. Joe Turner, one of my mentors and dearest friends. I've known them for 3 decades, more than 3 decades. They publish their research, and you can go to their website and sign up for their monthly newsletter. And I'm going to end right there because my time is up.
Yeah, we're going to move on to the 10 and 10, but just one last question, and that is, if you've been on the sidelines waiting for a pullback, do you think you're going to get a better opportunity than right now?
Yes, I think that this pullback, if we get the backing up action, which is halting and slow, I think it could take weeks, a number of weeks to unfold, to process this advance we've just had. And I hope that it's shallow, non-volatile, shows elements of absorption. And I think that the opportunity, remember the springs we had at the end of both of those examples I looked at, we may or may not get that, but that would be a great time to get busy and start to look for the next leg up in the market. And so I don't know that I've solved my dilemma, but I appreciate you all listening to me here. This has been like Wyckoff therapy for me, and I may not be any clearer on what's going to happen, but I feel better.
That's good. I feel a little bit better too. So, and we're going to have you back for another therapy session, in another few weeks. So, this isn't the end of it.
Oh, good. Thank you. Well, this did help.
Bruce, thank you so much for coming in today. You did a great job. Always great to have you on the show, my friend.
Thank you so much. Great to be here.
Hi, this is Arthur Hill, Senior Technical Analyst with StockCharts.com. Today's instructional video will show you how the dynamic yield curve works. Here are the topics in the timeline for today. First, we'll show you how you can access the dynamic yield curve. Then we will go over the parts of the page. We'll show you how to work with the trail length. Then we'll show you how to compare using snapshots. And finally, we'll go over the clear, animate, and show info functions. Accessing the dynamic yield curve. I'm here on the free charts page, and there are 2 places you can access the dynamic yield curve. The first is on the right navigation. You see charting tools, and at the bottom you have the dynamic yield curve link. You can also scroll down the page, and you will see the different sections, and you see a section for the dynamic yield curve, and you just click that button to launch it. You can also access the dynamic yield curve from the members page if you click on that link at the top. And on the left, you have your control center. And if you scroll down, you'll see charting tools. And at the bottom, you will see the dynamic yield curve. Parts of the dynamic yield curve page. On the left-hand side of the page, we have the yield curve itself, and that is shown in the yield curve pane. The red line is the yield curve. On the y-axis, we can see the range for the yield. On the x-axis, we can see the maturities, 3 months, 2 years, 5 years, all the way to 30 years. On the right side, we have the S&P 500 for reference with the date scale at the bottom and the price scale on the y-axis. The current date shown here is the 27th of October. And on the right, we have the date slider, and you can move that date line. I can click and drag it to a particular spot, or I can click anywhere on the chart to move it. So if I see a high here and I want to see what the yield curve looked like then, I can click right there on the chart and then look at the yield curve. And I can also slide this, and the yield curve will change as I slide along the date axis of the S&P 500 chart. At the bottom, we have some other controls: trail length, snapshot, clear, and animate, which I'll go over in more detail in a minute. And we also have links for quick tips, instructions, and a permalink if you want to share that chart. Working with the trail length. Chartists can use the trail length to see how the yield curve has changed over time, and it's about a 6-month trail. So I've selected the 2007 high on the S&P 500 as my starting point. If I go to the trail length slider and I move that out to the maximum, you can see how the yield curve has changed. The shorter yields were above 4.65% at the beginning of the period, and they moved down as we came into this point in 2007, September 2007. And again, we can click on any point on that S&P 500 chart to see how the yield curve looked at that particular time. And you can see I'm near the 2008-2009 lows. The current yield curve is in red, and you can see the darker lines show how it has changed over the last 6 months or so. You can see the longer yields have come down significantly. Comparing with snapshots. We can also use the snapshot feature to compare the yield curve to various points in time. So again, I'm going to go to this 2007 high because it was a significant event here. And you can see the yield curve as it is now, around 4.65% roughly. And I'm going to take a snapshot by clicking the snapshot button. Now, when I click on the red date slider line, I'm going to see how the yield curve compares to that snapshot. So I'm going to go ahead and stop it at the 2009 low. So we have our snapshot in 2007, and now you can see at the 2009 low, the yield curve looks completely different. Using the clear, animate, and show info functions. If I want to remove the snapshot that I've taken, I would just click the clear button there, and that snapshot will be removed. You can also animate the yield curve to see how it has changed from a particular point in time. So again, I'll move to the 2007 high, and if I want to see that exact high, I can click the show info box, tick that box, and then scroll up to see the high and the price. If I click the animate button, I will get an animated yield curve. So you can see the yield curve is changing as we move along the date axis of the S&P 500 chart. I can always pause that if I want to see the yield curve at a particular point in time, and then click animate to reanimate it. And that concludes this instructional video on the dynamic yield curve. Thanks very much for tuning in, and be sure to check out our other instructional videos.